Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well. Good morning, everyone. Hope you're well. Get this sorted. The thing won't turn off. Got myself a bit of an issue going on here. Hang on. Come on, you good thing. There we go. Hey, good morning, everyone. Good to see you. Hope you're well. On this terrific Tuesday. Who's a little bit wet. I'm in the GC right now, and it's meant to be always sunny up here, but it's not today. Good to see you, folks. Thanks for joining me this morning. Welcome to another Wealth Coffee Chat. Got a few of the early crew up and at it. Sharon, good morning. Good to see you. Where is JFF? Anyway, hey from Jeff. Jeff, is that you, Jeff? Good morning. Hey, folks. Good to see you here. Let's do the little warm-ups while we get things going, as we always do. You guys know the drill, but if you don't already know, Jason Witten's my name. Most of you know that, though. If you're new and you don't, welcome. Good to see you. Thanks for joining. Fabulous to have you here. Let us know in the chat where you're coming in from. What's the go? How are you traveling when it comes to... yeah, Julie effing Fletcher. Hey, Jules. Good to see you, mate. I should have known that. I was thinking of John F. Kennedy or something like that. Anyway, not sharp enough this morning, Jules. Haven't had enough coffee. Great to see you here. That's awesome. And welcome along. Good to have a bunch of you on. A few people from Brizzy. There you go. It's all happening today. I did hear shout out to or sending good vibes and energy to those in Queenstown. They had a bit of a landslide over in New Zealand. Hopefully everyone's well and thinking about them. All right, let's get into it. What are we doing today? Hey, I thought we might have a bit of a chat when it comes to the idea, overall theory, concept, conversation of investing today, and nuts and bolts of things when it comes to understanding the mechanism of, let's say, our, the game we're playing. What game are we playing? What pulls the levers? What creates the momentum? How do we win when it comes to this property investing stuff? What are the things that we can do to make it go faster? What are the things that we need to do to make sure we, be more efficient, et cetera, et cetera. So wanted to do maybe a bit of a high level look at things today and show you a little model, a little process, that I call the 4 quadrants of property investing. And, it could probably apply to other things as well. But, as a property investor, we want to be able to do a few things when it comes to investing and doing things fast, efficient, and making sure we get momentum is certainly something we need to be able to achieve. So let's go and have a little look at what I'm talking about today maybe share a little bit of this idea, a little bit of this wisdom. The idea that, there's 4 parts to the world of us becoming, us buying enough properties as we go. Right. So what do you think? What do you think the 4 parts are? And I'm trying to sort of not give it away, but chuck it in the chat. What are the 4 bits? And it's more practical, not, emotional or mental at this point in time, but that does play a part sometimes. What are the 4 machinations, the 4 mechanical parts of investing that we need to manage and maintain? What has to happen? What do we need to do? Anyone have a guess? Chuck it in the chat if you think you know what it is. And I'll put it in here. Right. Number 1, finances. Yes. So some of it is. Number 1, income. Right. Income, folks. Unless you've got cash stashed under your pillow, some people do. Maybe it's stashed somewhere else. Unless you've got cash, flash, you need an income, and a pretty good income, to be honest. And you want that income to go up over time, right? Go up over time. And we need to be able to borrow. That's debt, okay? Finances. We need to manage our debts, income and debt, to then purchase some assets which do some things over time, go up in value, give us some income from rent, get us some tax deductions, et cetera, et cetera. And what's the missing piece here? What do we need to manage? We've got some income, we borrowed, we got some debt, we purchased some assets, and there's a piece of this puzzle that we need to make sure we manage. And it's a pain in the backside, but everyone has this exposure in their world of wealth, and that is the taxes. All right. So this is how it works, folks. You manage your income, you buy some assets, we manage the taxes, we manage the debt that feeds back to our income, and we can buy some more assets, get some more tax deductions, feedback, et cetera, et cetera. This is the cycle we manage and play. So let's dive into the detail of that. And I've got a little model here I'm going to show you guys. So what is it? What do we look like here? What does it look like when it comes to our income? All right. The income game. Do you have a regular job? PAYG. PAYG. Now, PAYG is if you've been to the bank, and you're trying to borrow money, well, they'll ask you, how do you earn your income? And you'll say, I've got a job. And they'll say, give me your pay slips. And you know what? 9 times out of 10, that's the easiest way to borrow money. Who on the call is not PAYG? I see 1 or 2 business owners on the call today, right? So PAYG, usually the easiest way to borrow money, usually the easiest way, folks. However, the challenge sometimes with PAYG is that it might be a slower way of creating money, let's say, because if you're in business or self-employed, couple self-employed here, if you're in business or you're self-employed, sometimes in the world of increasing your income, that seems to be easier. Now, depend on your skills. Morning, Alison. Depending on your job, depending on your career, so in ease, like PAYG, everyone kind of understands it when it comes to income, self-employed or business owner, a little bit different. And then at some point, some of us, hopefully all of us, will be producing our income from investments. You would be income created from investments. All right. Now, this creates issues and problems over time and opportunities, by the way, if we're growing our portfolio. So your income, what's the number one thing here, folks? The number one thing that can accelerate your wealth in the early days is to do what? Tell me. For you, most of us, yeah. I know, Alison, one day you'll spread your wings, I'm sure, and you'll do something pretty cool like that, I reckon. There's something in the future for you. From what I know, if you set your mind to something, you'll knock it out of the park. Anyway, so for us as investors, the number one thing you can do to accelerate your wealth, accelerate your investing is increase your income, folks. Increase your income. It is the one thing, it's the one thing that you know, sometimes you've got a little bit of control over it, influence. Sometimes you've got a lot of control. You increase your income, and then that equals the ability to borrow and buy more assets. Now, we've got to get the deposit and that sort of jazz, but more income equals more wealth. The sooner you get earning more income, the better off you're going to be, folks. So, number one goal here in the world of income is increase it. Increase it as fast as possible, right? And keep it going. What do? You transform those dollars into assets, folks. The dollars transform into assets. Increase your income, borrow money. You know, a lot of people, I've heard a fair bit of talk about being, you know, afraid of debt, right? So good debt is excellent. Good debt that creates an income, creates tax deductions, grows in value when you buy an asset, you know, and eventually an asset that pays its debt off as well. You know, that's good too. So you buy an asset, right? So those assets, what are those assets? Well, you know, this is another thing here. You know, the four types of assets, very simply, that I reckon you can invest in is number one, you. The more you can learn and earn, you can grow assets, grow wealth, right? The second one, I think the easiest one to transform your income in the world of investing is property. And that's, listen, in New Zealand and Australia, it's the easiest one. It's the one the financial system is built around. You can certainly buy shares. It's not my specialty. So, you know, however, easy one, turn your earnings into an asset, buy some property. You know, if you bought some shares, you could create a business. I'm a big fan of all of them, right? So you increase your income, you increase the asset base, okay, assets. I like the idea of using leverage at this point in time, certainly in the beginning. You know, if you use lending and leverage, it's the magic of other people's money. You can borrow from the bank and get, I don't know, 6%. You can borrow money, depending on your income. You can borrow money at 6%, and let's say you went and made 10% with it. Great. Nothing wrong with that. You know, that's the idea as you go. Yeah, awesome, Allison. I'm excited for you, buddy. As we go, right? So we create income, we buy assets, and we need to manage, folks, we need to manage our taxes. We need to manage our taxes. These cheeky taxes, I tell you, taxes down here. These taxes. And morning, Fritz. Good to see you, mate. We need to manage our taxes, ladies and gents. Like income tax. You know, if you earn more, you could be paying, or on a tax rate, folks, up to 47%. You know, how does that work? How does that work? Holy gee. Like, hey, check this one out. If you earn, I'm just going to, I'll blow your socks off for a second. If you earn $180,000, let's say, and just let's say you start work at 25 and you earn $180,000 just straight, folks. Let's just go straight. Now, this is just, you know, let's say you earned $180,000 from age 25 to 65, just straight for 40 years. How much PAYG tax would you pay? Put that in the chat for me. Tell me, folks, how much would you pay? This is ludicrous. Ludicrous. Put it in the chat. Tell me, what do you reckon? How much money, how much tax would you pay over a 40-year period if you earned 180? Now, you can do these numbers. I've got 110 there somewhere too, but 180 is mind-blowing. Maybe you don't know. Maybe you don't know. Well, let's double that, Facebook user. Insane. $4.2 million. Ludicrous. Ludicrous, folks. Like absolutely off the charts, bloody stupid, right? Cray. Anyway, there you go. So, we pay millions of dollars in taxes, millions of dollars in taxes, folks, over 40 years. Stamp duty, you buy some property, you want to minimize your stamp duty. Can you minimize stamp duty? Yes, you can. Yes, you can, folks. There's ways, who knows how to pay no stamp duty? Well, you get a crack. Most first home buyers get a crack at paying no stamp duty at least once. How else can you minimize your stamp duty? Well, you can buy a house and land. You only pay stamp duty on the land portion. And right now, that's not a bad strategy, to be honest. You can buy a piece of land. You can get a really nice house built. That might cost you $300,000, $400,000, $500,000 to build a really nice house. And you don't pay any stamp duty on the construction of the house. This is smart, right? Capital gains tax. You've got to minimize that. How do you pay low to no capital gains tax? There's strategies, folks. There's ways to pay zero capital gains tax, ladies and gents. You can pay zero. There's a few ways to do that very legally. Number one, it's your principal place of residence. There's no capital gains tax. There's a couple of other moves as well where you can have low to no capital gains tax if you know what you're doing. You know what you're doing. Land tax, folks. Land tax is a state-based tax, and it has thresholds and ownership. So, and don't sell. Exactly. Why would you sell? If you've got a good property, why would you sell it, right? Well, there is some strategic reasons to sell. Now, we've had this chat with Andy Fenton before. You own the properties outside of, let's say, super for maybe 10, 15 years, 20 years. And then if you sold those properties at the right time and your super was knocked into shape, then you could transfer the gain into your super tax-free if you do it right. And then you buy another asset inside your super and then off you go. And then that becomes tax-free for the rest of its life. It's pretty smart. It's not bad. Yeah. If you want to be a politician, you can get 2 houses capital gains tax-free. How's that shit? That's for real, by the way, folks. That's for real. Anyway, land tax, it's state-based, okay? It's state-based. It has a threshold. And, if you purchase multiple properties in different states under the threshold, well, folks, you can pay no land tax. Who likes that idea? Do you like that idea? Would it be better if you had multiple states for diversification and safety, different economies, and paid zero land tax than buying, 5 in your backyard and paying land tax? Folks, there's a strategy, there's a process, all right, as we go. And last but not least, ladies and gents, you need to manage the debt, right? Debt. You need to make sure that it is all investment debt. Investment debt means this. Number one, it creates an income. Number two, it gives you a tax deduction. All right. And number three, over time, the asset grows in value. Asset grows in value. Okay. That's what the debt's meant to do. If it doesn't do all three of those things, then the debt becomes heavy and it can't handle itself. Right. Now, you've got to keep an eye on your home debt, your principal place of residence debt. It doesn't bring in an income. It doesn't give you a tax deduction for your income, but it does give you a tax deduction for capital gains tax, and it goes up in value. So it's kind of like it's got a foot in both camps. So, if you manage that properly, it can turn into an asset, a brilliant one. Consumer debt, credit cards, all that sort of shit. Terrible for your ability to borrow. Credit cards, those things, any debt that does you buy things with, it goes down in value, creates a cost with no income. Folks, get off the crack cocaine of your financial woes. Credit cards are no good, right? Don't do it. And business debt, depends. It depends. It depends if it helps you increase your income, then fine. It's tax deductible. It can be fine, right? Now, there's a bunch more we could go through. There's a whole lot more in this model, in this strategy. We can drill into goals, strategy, structures, and tactics. We can drill into what I call the wealth identity, mind, body, heart, and soul, where you have a look at what drives you and your decisions as we go. That you go. It depends on the type of positive cash flow property, Paul. And yeah, at the end of the day, most of your properties will kick into what we would call a positive cash flow pre-tax, right? So positive cash flow before tax. Go and do the math on that one. Download the calculator. That has to be significantly high income. The sweet spot, Paul, to be quite honest, is a positive cash flow property after tax. And we found that being the sweet spot for most property investors looking for that buy and hold over a 7 to 15 year window to buy 4 to 5 good investment properties. That's kind of the sweet spot. But sit down with your coach, download the calculator, run some scenarios, work out the best cash flow situation for you as you grow. Because often when you chase a high cash flow property, we often sacrifice some things which are, capital growth often, okay, as we go along. So that's kind of usually what happens. But sometimes you can get those unicorns that do a bit of both. There you go. I just bought a property, brand new property, paid $609. I furnished it, and now it's renting for $810 a week, folks. Brand new, absolutely brilliant. Yeah, Brendan, listen, you're probably 7 to 8% gross yield to be positive cash flow pre-tax, depending on some of the other costs, Brendan. And that's where you go, right? Rates, stamp duty, insurances, land tax if you got it, created, if you got it owned in the wrong way. There's a few things. If you just think about, Brendan, the interest rate, if your interest rate is 7%, mate, right, you need a full 1% above that to cover the costs. So that's 8%. And then if you want some left over, that'd be 9%. Do you know what I mean? So that's kind of very rough. But listen, folks, download our calculator. It's in the Facebook group, and it's in the Facebook group, and you can knock that into shape. Oh, that's so fantastic. Yeah. Listen, folks, you should be paying your home off, right? And this is the thing. Get rid of the debt on your home, and you could use it as security to acquire more assets. Now, the whole debt is tax deductible, or you can just have your whole home paid off and, get your investments going out there. Well done. So good. So good. That's awesome. That's an amazing achievement. Well done. That's made my day. Yeah. Oh, that's great. All right, folks. That's it. I think I've gone over, but you know what I mean? There's some things we've got to get mastered as investors. We will keep ourselves on track. There you go. All right, folks, that's it from me. You guys know the drill. We can hang out again tomorrow if you're up for it. Wealth Coffee Chats usually kick off at about 8:10 each day. Well, that's Queensland time. It's usually 9:10 somewhere else. Yeah, if you've got something that's worth me having a bit of a chat about, let me know in the chat, in the comments. I always have a look afterwards. So join me tomorrow if you're up for it. And till then, folks, remember, we've got a couple of sayings around here. You guys know the drill. Buy well, don't sell, unless it's strategic to move your asset from one place to another tax-free. Anyway, that doesn't sound as good, does it? Anyway, there you go. All right, folks, I'm just rambling on now. All right, that's it. Great to see you. Thanks for joining. See you tomorrow. Bye for now. Welcome to another Wealth Coffee Chats. Marvelous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong life for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.